everyone. My name is Marilena and I will be your hostess for today. Together with me, I have Peter, our senior market analyst at IronFX. Hello, Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals and driving the markets currently. So, Peter, how have the markets moved at yesterday's opening and over the next session?
Well, actually, we had the reaffirmation of the market's cautious stance. It was characteristic how the US dollar strengthened across the board. And at the same time, I would dare to note that we may see such tendencies being intensified over the coming days, and that could have practically an adverse effect on riskier assets such as commodity currencies, the pound, which may weaken somewhat and end the week lower. However, that remains to be seen.
Has the strengthening of the USD weighted on the gold's price?
Actually, it did. It was very characteristic how gold's and the US dollar's directions diverge. On the one hand, we have a US dollar which is strengthening day by day, while on the flip side, we have a gold price which drops day by day. I would dare to say that the denomination of the precious metal in US dollars more or less enhanced the negative correlation of the USD against gold's price.
And what about US stock markets? Is the earnings season about to begin?
Yes, US stock markets yesterday opened on the back foot. They had a slight drop. All three main indexes, the Dow Jones, S&P 500, NASDAQ, they all dropped a bit, edged lower. Today we have the first earnings result, which is of some substantial interest. It would be PepsiCo. However, I would be highlighting Microsoft. I think that's on Thursday, while others are to follow as well. So we may see the earnings season affecting the stock markets, generating more interest among traders. It's going to be interesting to see whether the US economic slowdown over Q2, which has been largely discussed among traders, is going to be reflected also on the earnings reports of the companies. And should that be the case, we may see traders being disappointed. We may see a cautious stance practically being reinforced, and that could drive stock markets even lower, while at the same time may drive more safe haven inflows towards the USD.
And Peter, there have been lots of headlines for the euro weakening. Should they understand that the common currency has reached parity levels against the USD?
Yeah, practically yes. Practically Euro USD has reached the level of 1, i.e. €1 for $1 parity level. The downward motion seems to be continuing. However, I would make a small break here. We have on the one hand a strengthening of the US dollar, which is clear. On the other hand, though, I would highlight that the euro is weakening also as currency as such. It was characteristic that the euro weakened not only against the US dollar, but also against the pound, the yen, and the Swiss franc, which was a sign of a broader weakness for the common currency. Fundamentally, the picture does not look so good. The fact that the Russians have cut the supply of natural gas for maintenance reasons of Nord Stream 1, despite a number of analysts citing the possibility of the Russians cutting permanently or extendedly the supply of natural gas, we wouldn't agree so much. It could be a sign of political leverage on behalf of the Russians. On the other hand, we have to note that the Russians do not actually have the infrastructure to divert the exports of natural gas to other clients such as China or India. So we think that the cut's going to be temporary. Most probably, even with some delay, it will return back to Europeans. But still, the situation is highly uncertain given the war in Ukraine. And on a macroeconomic level, we have to note that economic activity is slowing down. At the same time, inflation remains high, and that tends to more or less darken the economic outlook for the Eurozone. Also, it would induce the ECB to proceed with rate hikes and the tightening of its monetary policy. On the other hand, though, the lack of growth for the economy of the Eurozone may create some hesitation in the ECB, and that could weaken the euro. That should be about it for the euro.
And across the channel, how has the pound been moving?
Well, the pound has also been weakening against the US dollar. Fortunately enough for pound trade, it's not against the euro, albeit it's not much stronger. We have similar issues. Albeit the economies of the Eurozone and the UK differ substantially. The one is more production-based, the other is more services-based. Still, we have a substantial economic slowdown of the UK economy. I would be highlighting, though, that Bank of England has adopted an even moderated approach in tightening its monetary policy, which more or less could also weaken the chances for economic growth within the UK. I would expect overall bearish tendencies, or at least the pound, to remain under pressure over the next couple of days.
Interesting. And what's on the calendar for today?
Well, as we're speaking, we're getting from Germany the CEF indicators. They are for July. Now, we have two indicators. The one is the economic outlook, practically, for the next 6 months for the German economy. The second is about the current conditions in the German economy. Both indicators are expected to drop deeper into the negatives. And practically that would imply that there is a greater degree of pessimism on behalf of investors and analysts about the outlook of the German economy. At the same time, the drop of the current conditions indicator would imply that the situation on the ground is actually getting worse, and the combination of the two could weaken the euro somewhat, or at least intensify the bearish tendencies for the common currency. I would be noting also the speeches of BOE Governor Andrew Bailey. He will be making comments twice. The first is in the late European session, the second is in the American session. And we're going to be having also Richmond Fed President Barkin. Now, Richmond Fed President Barkin was more or less leaning towards the hawkish side. So should he make comments in that tone, we may see the US dollar strengthening even further. Oil traders, on the other hand, are expected to keep an eye out for the AP weekly crude oil inventories figure. The last release showed a build-up of US oil inventories at the rate of around 3.5 million barrels. Should we see another substantial increase of US inventories, that would imply practically that we have an overshoot of production over demand levels, thus implying, I would dare to say, a slack in the US oil market, which could weaken oil prices. Mind you that tomorrow we are also getting the EIA crude oil inventories figure, which will be also kept under eye by oil traders. And during tomorrow's Asian session, we are highlighting for Aussie traders China's trade data. It's well known how closely linked the Australian and the Chinese economies are, as the Australian economy is exporting raw materials towards China to feed practically China's gigantic manufacturing sector. Should we see a deceleration of the import growth rate, we may see the Aussie weakening, as practically that would imply also less exports of raw materials from Australia towards China. Also, I would be noting the trade balance figure, but I think Aussie traders will be more focusing on the import growth rate.
Isn't also RBNZ to release its interest rate decision tomorrow?
Yes, RBNZ is to release its interest rate decision tomorrow. The bank is widely expected to hike rates, and the market seems to be largely pricing in the possibility of a double rate hike by raising the official cash rate from 2% to 2.5%. It's characteristic that some market participants are even discussing the possibility of a triple rate hike, and that's indicative of how hawkish the expectations of the market are for the bank right now. I would also be noting that we have rather high inflationary pressures. At the same time, we have a rather tight labor market in New Zealand. Both of these factors practically satisfy the mandate of the Reserve Bank of New Zealand, which is to practically keep inflation low and at the same time promote maximum employment. And that would allow the bank to proceed with substantial, let's say, rise of the cash rate. On the other hand, though, we had a substantial slowdown of the GDP rate, and that may be advising some caution for the bank. I would also expect the bank to proceed with a 50 basis points rate hike. That's our base scenario for now. But for the Kiwi, given that the market has already priced in the scenario, for the Kiwi to get some substantial support, we may require something more. Say, for example, the bank proceeding with a 50 basis point rate hike and actually accompanying the decision with a hawkish forward guidance, citing more rate hikes to come in the following meetings. That could be providing some confidence among Kiwi traders to once again bid for the Kiwi. More or less, that should be it.
Any final comments, Peter?
Well, should we see an extension of the cautious sentiment of the market? Once again, we may see the US dollar gaining. However, I would expect some moderation here, as the opening of Monday more or less has elapsed and may have shown the intentions of the market. I would be highlighting the risk, which is for assets such as stock markets or commodity currencies such as the Aussie, the Kiwi, the Canadian dollar. And I would even dare to note the pound as well.
Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
Welcome to the technical analysis part of the presentation for today. We make a start as usually with the USD index for our chart. Note, let me make a readjustment here. There you go. Note how the US dollar index continued to rise, breaking above the 107.50. That would practically create a new upward trend line. Let's make the necessary adjustments here. The R1 now becomes the S1. And adding a new resistance line at 112. In red. Let's have a look. Record high. So based on the previous resistance line and the movement, let's make the readjustments. It was clear how the US dollar strengthened across the board yesterday. So practically we may have to revisit a number of charts. 107.50 becomes now the first support line. Used to be a resistance line. 105.50, the first, sorry, 109.50. The first resistance line, second resistance line being placed at 111.40. And the final resistance line being placed at 113.50. Locking it in. Here we go. Let's proceed with the technical analysis. Now, we have a US dollar which has been strengthening over the past 24 hours. It was characteristic how the price action of the index practically broke above the 107.50. Note that the 107.50 provided some considerable resistance for the index around the 8th of July. That was practically on Friday. Now it's been broken. We tend to maintain a bullish outlook for the price action of the index as long as it remains above the upward trend line, which has been formed practically since the 5th of July. A small word of caution, actually two. The first would be the RSI indicator, which has risen above the reading of 70, which on the one hand definitely underscores how bullish the tendencies are within the market. On the other hand, though, may imply that the market, or if you prefer the pair, has reached overbought levels and may be ripe for a correction lower. Also, the second word of caution would be the price action which has been flirting with the upper boundary of the Bollinger Bands, which may force the price action to slow down its rise, maybe even correct a little bit lower. Yet overall, once again, we maintain our bullish outlook for the index as long as it remains above the upward trend line we have mentioned before. Should the bulls actually maintain control, we may see the price action breaking the 109.50 and start actively aiming for the 111.40. On the flip side, should some stabilization take place, we would expect it to remain, actually I would expect it to break the upward trend line, yet remain between the 109.50 and the 107.50. A bearish outlook could follow should the price action reverse direction, break the prementioned upward trend line. We would require also a clear breaking of the 107.50 support line and start actively aiming for the 105.55 support level. Note how the 105.55 was a prior resistance level before turning to support, as was also the 107.50, as the price action moved decisively higher. That's it. Let's have a look at Euro USD. Euro USD, which has reached now the parity level at 1.0. We should change the first support line to resistance line, given that the price action has moved below it. And let's go hunting for another support line. Could be a little bit wider. be somewhere here as well. We're talking about pretty narrow. No, I will prefer this one. It should be also, yeah. Let's zoom in. Yeah. That would be the 0.98680 in green. That's it. Let's drill back down to the 4 chart, zoom out, readjust, and let's correct our levels. $1.0355 is the new final resistance line. $1.0210. One is the new first support line, which is being tested by the price action right now. 0.9870, second support line, and the next one being placed at 0.9680, the final support line. There we have it. Now, for the time being, we tend to maintain a bearish outlook for the pair, given that it has moved lower, broken the 1.01 support line, now turned to resistance, and it's currently testing the parallel level of 1. As long as the price action maintains a direction or remains below the downward trend line, which we have mentioned and was initiated since the 5th of July, we maintain our bearish outlook. Also note that the RSI indicator has moved below the reading of 30, once again underscoring the dominance of the bears for Euro USD. At the same time, though, may also imply that the pair has reached oversold levels and may correct higher. Should the bears maintain control, we may see the price action, which currently seems to be finding some support at parallel level, breaking the S1, and start actively aiming for 0.9870. On the flip side, should a stabilization take place, we may see the price action remaining between the 1.01 and the level of 1. That would imply practically a breaking of the mentioned downward trend line, while an upward movement would imply that it would break the mentioned downward trend line, break the 1.01. I would actually require that for a bullish outlook. And I would also require a clear aiming of the 1.0210. Note also how the price action is actually flirting with the lower boundary of the Bollinger Bands. It's quite interesting to see how and if the price action will break the parallel level and Euro USD is going to slide below it. Probably it will, but we'll have to wait and see. Let's have a look now at cable, and this is GBP USDs for our chart. Cable which has moved decisively lower, as we have mentioned yesterday, and we expected it to break the downward triangle which we had mentioned. So the downward motion continues. A summary adjustment will be required here. Let's go hunting for a new support line. Weekly. Oh, we have some movement here. That's interesting. Let's drill down to the day chart. Okay, that's interesting. 4-hour chart. Okay. It's a little bit too too wide to place it. I would be calling this one. You may see some support in the 1-hour chart as well. Let's have a look. Okay. So we have one movement down low here and another one here. I would be keeping the mid level. Let's have a look. Yep. Horizontal line properties, coloring it in green, and it's going to be the 1.1525. Now the 1.1935, as the price action has broken the support line, turns now into a resistance line. Let's make the corrections on labels. 1.2125. 1.2070. First resistance line being placed at 1.1935 used to be support line, but as the price action has broken below it, has now turned into resistance line. First support line is being placed at 1.1815. Second support line being placed at 1.40. And final support line, being placed at 1.1525. Not exactly symmetrical, but symmetry is not what we're looking for. And I'm also highlighting the S4 being placed at 1.1405. For the time being though, let's hide this. The S1 is still being tested. So I would be keeping some cautious stance here. Overall though, there is a clear downward movement. which intensified over the past 36 hours. We maintain a bearish outlook for the pair as long as it remains below the downward trend line, which was incepted practically since the 27th of June. Note how we have a formation of lower peaks and lower troughs, maybe with one exception here. But yesterday's movement practically reaffirmed the bearish tendencies. So we maintain a bearish outlook as long as the price action remains below the downward trend line. The RSI indicator is just touching the reading of 30. Maybe has not reached oversold levels. Should the bears maintain control, we may see the price action breaking the 1.1815 and start aiming for the 1.1640. On the other hand, the bears may still be in control despite a correction higher and a subsequent drop lower of the price action, once again dropping the 1.1640. On the flip side, should a stabilization occur, we may see the price action revolving between the 1.1935 and the 1.1815. For a bullish outlook, we would require a clear breaking of the R1, a breaking of the pre-mentioned downward trend line, and the pair to actively aim, if not reach, the 1.2070 for us to switch our bearish outlook in favor of a bullish one. Let's go now to USD/JPY. USD/JPY, which remains rather stable after breaking the 136.75 support line, resistance line, now turned to support. It has stabilized above it. Not much volatility here. We maintain a bias for a sideways movement to continue, given also that the past action over the past 24 hours after the breaking of the 136.75. On the other hand, the RSI indicator remains, or at least has stabilized between the readings of 50 and 70. Some slight bullish tendencies could be present for the pair, which for the time being do not seem to be evident. Should the bulls actually take over, we may see the price action rising, breaking the 138.50, which would be a new 24-year high for the pair, and start to aim for the 138.80. On the flip side, should the bears take over, we may see the price action dropping, breaking the S1 136.75, possibly also breaking the mid-level, which we have mentioned here. Let's delete this. And start actively aim for the 134.45 support line, which is the S2. Note that there is a very slightly downward slope for the RSI indicator, which could be inviting for the bears. Also note how the price action has also moved slightly slower, just a bit. But overall, still resembles a sideways movement. Let's have a look now at USD CAD. USD CAD, which rose a bit, yet the overall sideways motion seems to be continuing. That's better. With two exceptions, the main body of the price action tends to remain between the 1.3075 and the 1.2970. We tend to maintain a bias for a sideways movement between the pre-mentioned levels, but we have to note that the RSI indicator has been on the rise, breaking above the reading of 50, aiming for higher grounds, which on the one hand it seems to be reflecting the upward momentum over the past 24 hours. On the other side, though, could imply some more room for the bulls to advance. Please note, though, that the price action has reached the upper Bollinger Band, which may limit the maneuverability of the bulls somewhat. Should the bulls actually take over, we may see the price action breaking the 1.3075 resistance line, that's the R1, and start actively aiming for the 1.32 resistance level. On the flip side, should the bears take over, I would expect the price action of USD CAD to drop, break the 1.2970, and start actively aiming for the 1.2865 S2. Let's also have a look at the Aussie. AUD, which has escaped the sideways motion it was in since the 1st of July and has broken below it. Hence we tend to switch 0.6760 from a support line to resistance line. Now let's go hunting for a new support line. Okay, this is taking too long. Daily chart. There you are. So we have actual touches here. That's nice. Let's drill down to the 4-hour chart. Middle out. Back to the daily chart. There we go. And it's the 0.64. We have to color this in green, sorry. Drilling back to the 4-hour chart, readjusting. Let's make the corrections on the labels, with the R3 being the 0.6950, starting from up, going downwards. The second resistance line being now placed at 0.6860. The first resistance line, which used to be a support line, is now being placed at 0.6760. First support line being placed at 0.6620. Second support line being placed at 0.65. Final support line being placed at 0.64. We maintained a bias for sideways motion between the 0.6760 and the 0.6860. Now, given that the price action has broken the lower boundary of the past sideways movement, given also that we have an RSI indicator which has moved decisively lower and is currently aiming for the reading of 30, we tend to adopt a bearish outlook for AUD USD. Overall, though, we have to note also the downward movement of the price action in a more long-term view. See how the price action has moved, creating lower peaks and consecutive lower truths. And I think that would be even more clear in the daily chart. Yep. I think that movement is going to continue lower. Maybe we're going to be having some hiccups, but overall, I wouldn't be surprised to see the price action aiming for 0.6620 within the next 24 hours. On the flip side, and to switch our bias for a bearish outlook in favor for a sideways movement, we would require a clear breaking of the 0.6760, a breaking of the pre-mentioned downward trend line. Yet the price action would have to respect the 0.6860 and stabilize somewhere between where it currently is and the 0.6760, or even stabilize just below the 0.6760 revolving around it. Yet that would take some considerable time for the downward trend line to be broken. In case of a bullish outlook, we would expect a breaking of the 0.6760, the downward trend line. The 0.6860 would also be required to be broken for a bullish outlook, and the price action to start actively aiming for the 0.6950. Quite interesting. Okay, let's have a look now at USD-CHF. USD-CHF, which maintains an upward motion. It's a clear upward trend line guiding it since the 29th of June. We expect the bearish outlook to be maintained, and in which case we would expect also the price action, despite the possible correction, given that the RSI indicator has broken above the reading of 70, to break the 0.9875 and start aiming for 0.9990. Once again, though, given that the RSI indicator below our forward chart has breached above the reading of 70, the pair may have reached overbought levels and may be ripe for a correction lower. But overall, unless the upward trend line is clearly broken, we wouldn't switch our bullish outlook. We would maintain it. Should, though, despite the base scenario, the market stabilize the pair somewhat, we're always talking about USD-CHF for our chart, we would expect the stabilization to take place between the 0.9875 and 0.9765. Should there be a bearish outlook? Now, for a bearish outlook, we would require clear breaking of the pre-mentioned upward trend line, which would be also the first sign of a trend reversal, the first signal. And we would also require clear breaking of the 0.9765 and for the price action to start aiming for 0.9640 S2 support level. Let's have a look at NZD-USD, given also that RBNZ is to deliver its interest rate decision tomorrow during the Asian session. Let's readjust, shift to the right, the downward trend line. Let's correct the the prior support line, given it has now turned to resistance as the price action has broken below it. Let's go hunting for another support line. Somewhere here. Note this touch here. Show to the forward chart. Not allowed, okay. Let's zoom in a little bit. It's a clear touch. Let's color this in green. 58.40. Readjusting, zooming out, drilling down to the forward chart, readjusting the levels. Now, it's a big question on whether RB and Z will be able to fundamentally affect the pair, as is expected to hike rates at least by 50 basis points. And on the other hand, though, I would like to note that we may see further weakening of Kiwi in case the interest rate decision actually disappoints traders, Kiwi traders. And such a disappointment could occur practically in case RBNZ fails to deliver on the 50 basis points rate hike, or if the contents of its forward guidance are not hawkish enough. Let me check this one, please. $0.599, okay. 0.5920, and the final support line being placed at 0.5840. So we tend to maintain our bearish outlook for the Kiwi against the US dollar, as long as the price action remains below the downward trend line, which intensified its downward slope practically since the 27th of June. But we have to note here that there were some bearish tendencies since the 15th, 16th of June. Should the price action, should RBNZ's interest rate decision actually excite traders, boost the confidence of Kiwi traders, we may see the price action jumping, breaking above the 0.6120 resistance line, maybe even breaking the downward trend line and stabilizing below the 0.6215. In an extreme bullish scenario, we may see the price action even breaking the 0.6215 and actually starting to aim for the 0.6290 resistance level. That would practically mean a sudden jump upwards, breaking the 0.6120, the prementioned downward trend line, the 0.6215, and start actively aiming for 0.6290. It's a very, very high movement volatility, if you prefer, given also the low volatility which has been characterizing the pair since the late European session yesterday. But on the one hand, we have tomorrow during the Asian session RBNZ's interest rate decision, and in the American session we have the US CPI rates, which are also expected to move the markets. But for a bullish scenario to occur, we would require substantial fundamental shift in favor of the Kiwi and against the US dollar, which may be possible, but for the time being could be improbable. So that would take us by surprise. The main scenario here seems to remain bearish, and we may see the price action actively starting to aim for 0.5990, but that's only in the case of RBNZ, say for example, disappoints Kiwi traders, or if the USD CPI rates accelerate more than expected, providing a push for the US dollar, a substantial push for the US dollar. That should sum it up from us here at IronFX. From all of us here, best wishes for solid trading.
Hello traders, my name is Emily. You know there are traders who trade like hunters. They choose a pair, set up a scenario, where to enter the market and where to exit and execute when the terms are favorable for their plan and only then. On the other hand, you have traders which are all over the place. Those traders who learn to pick and choose their trades smartly usually tend to be the ones that succeed in the long term and evolve their trading style along with them. Whereas those traders who tend to overtrade usually rely on luck and intuition. Also, random trading or trading with insufficient information could prove costly both on opportunities missed as well as possible losses. So get a plan, be patient, and stick to it. Don't let your emotions overwhelm you, control them and make them work for you. From all of us here at IronFX, best wishes for solid trading. Hello traders, my name is Emily. You know there are traders who trade like hunters. They choose a pair, set up a scenario, where to enter the market and where to exit and execute when the terms are favorable for their plan and only then. On the other hand, you have traders which are all over the place. Those traders who learn to pick and choose their trades smartly usually tend to be the ones that succeed in the long term and evolve their trading style along with them. Whereas those traders who tend to overtrade usually rely on luck and intuition. Also, random trading or trading with insufficient information could prove costly both on opportunities missed as well as possible losses. So get a plan, be patient, and stick to it. Don't let your emotions overwhelm you, control them and make them work for you. From all of us here at IronFX, best wishes for solid trading.
Yeah, today's session will be from Botswana. That's good stuff, man. That's good stuff, right? Yeah, it's Mokunoto is asking how do we get the recordings, right? The recordings will actually be uploaded onto IronFX YouTube channel, right? I'll be showing you guys how to get that in a minute, right? It should be uploaded today or maybe by the end of this week. Pretty exciting stuff, right? So we had a session yesterday, right? Same time, same place. Not same time, same place, but it's every Wednesday is our live education session, right? It's a live education session where we jump, where we actually take you on a journey, right? Learning how to trade, from an institutional perspective, right? So every Tuesday is theory, every Wednesday is theory, every Thursday is practice, because there is no use, right? If you're learning everything without actually applying it, right? So that is the purpose of today's session. It's we're actually going to practice what we've learned yesterday and in our ongoing sessions. I'm just going to show you how I take on the markets, right? So importantly, I feel it is you watching me break down analysis, look at markets, identify opportunities, right? Very nice to see you tune in. UK, I'm assuming is United Kingdom, yet to Phileas from Norway. Oh, that's nice. That's nice. Thanks for joining me, guys. Right. Without further ado, let's begin today's session. Right. Right. You can see that there's a place for you to send your questions, right? To Phileas, you want to send your there's this little drop down. You want to send it to everyone, or you only want to send it to hosts and panelists. You can edit that, right? But this group of you guys, right? Over time, this as we grow this community, right? This especially the people who are following this webinar series, right? I'll be introducing you very soon, right? Probably it'll probably be launched next week into a VIP portal, which we're launching here at IronFX, right? It actually allows you to have a direct line to me, a direct line to my team of prop traders, right? To the other IronFX analysts, where you can actually ask us anything about the markets, right? If you have try and draw a trend line, try and draw support and resistance, right? And you kind of want to see if you're doing it right, that is where you can actually jump in. I'll be showing you guys how to get access to it in a bit. All right. But all right, it's nice to see that everyone knows how to use the chat, right? Today's session, I'm doing it from home. So, so let's begin. All right. Yeah. So our webinar session today, live trading session, you should be able to see my screen. If not able to see my screen, let me know. Right. Of course, just to the usual disclaimer, right, that trading CFDs is dangerous. Remember, this webinar is purely educational in nature, so nothing in this webinar should be construed as investment or trading advice. Please do your own little due diligence before you guys trade. Okay. But also, in this live trading session, I'm going to look at some really key setups on the markets. What I feel are the what are good ones and the ones that we can probably avoid. Right, we actually look at all the asset classes, meaning we look at forex, we look at indices, we look at equities, we look at crypto. If you have a request on a particular currency pair or a particular instrument that you want me to look at, I recommend that you send it in the comment section, right? Because I will try to attend to it sequentially, right? So if yours is slightly lower, right, then we might not get to it by the end of the webinar. So if you have a particular request or you're looking at a currency pair you want me to take a look at, let me know, right? And if it's on a particular time frame too, also let me know, right? Because sometimes you're looking at something on a long-term horizon, sometimes you're looking at something on a shorter-term horizon, right? Just send it in the comment section, all right? Anyway, for those of you guys who are here for the first time, right, or those of you guys who are here, like Rita, right, for the second time, right? This is introducing your host for today. This is me, Desmond Leong. So I run an award-winning research firm, Average Fortune Group, right? And we're actually finalists for Best FX Research 2019, 2020, 2021, and Best Equity Research 2020 and 2021, right? So we usually work with major financial institutions out there, hedge funds, banks, right? We advise them on where the markets are heading, but we have a special partnership with IronFX, where we are bringing you guys the good stuff, the juicy stuff, right? The stuff that will take your trading to the next level, right? And as many of you guys can tell, I am pretty young, right? I'm pretty young, 32 years old, right? So if there's any encouragement that I like to share with you guys is that you don't need to spend, 30 years in trading to be a profitable trader. You just need to spend 30 days learning the right stuff, right? And that's what we hope to do here at IronFX, is to really bring you guys the correct education. Because I often say, when in world of trading is different from the world of academia, right? Academia, the more you study, the better you do, right? The more you prepare for an exam, the better you do, right? But the world of trading is very different, right? You can learn the wrong stuff. You can learn the right stuff, but apply it wrongly, right? For example, if you're later, we have an example about this. Like maybe if you apply stochastic, RSI, MACD, all on the same chart and all telling you overbought, right? It's not going to be effective because you're all using a single, the oscillators, right? You need to combine different studies from different places, give yourself the best chance of a profitable trade. Okay, I'll be showing you how to do that later, right? I got a little bit of a checklist for you guys to look at. But yeah, if there's any encouragement I want to share with you guys is that, you just need to learn the right stuff. Okay, you don't need, it's more important to not run full speed in the wrong direction. Okay, because that's something which happens a lot in trading. People tend to run full speed, right? They see a trading strategy out there, they see it on baby pips, right? They see it on Forex Factory, they see a trading strategy, they get excited and they jump straight into it. And, before you know it, you're making losses, right? And today I'm going to teach you how to avoid all that. Okay. Now let's begin today's session. I'm going to touch on a few key things. The first agenda, right, is that the key approach we're going to take to trading. I am a heavily technical trader. Okay, heavily technical means that I used a lot of technical analysis when it comes to trading, right? I made a career. My entire trading approach is technical analysis, right? I do know the fundamentals. I use it slightly differently from everyone else, right? But the technicals, I'm very, very strong in it. Okay, I'll be showing you how I filter out what I call high probability setups. Okay, in trading, you're always looking for the highest probability, right? And we do that through this thing called confluence. Confluence meaning that we find multiple things that line up together to, to give you the best chance of being profitable. Okay, we're going to look at a cheat sheet, which a checklist rather, that I prepared for you guys later. I let the rest of my my prop trader team use it in the office too, right? I'll be showing you how to use it, right? Or I'll be sharing it with you. You probably won't know how to use it right away, but yeah, I'll teach you guys how to use it over time. Okay, then we go and take on the markets together, right? And that is where I'm going to look at. I use TradingView to look at some of my charts. We break down kind of some of the key setups, high probability setups that we can look at, right? And yeah, it's going to be fun. Now, guys, this is the checklist, right? Feel free to take a screenshot of it if you want, right? But this is really the checklist I use when it comes to trading. Let me see if I can actually have a pen. Yeah, I have an annotation pen over here. I can draw, and yeah, can I draw? Can I just move stuff? Yeah, I can move stuff here. But how do I increase the thickness of my pen? No, never mind. I'll just use this one now. All right. So yeah, when it comes to this kind of checklist, right? There are many different kind of things that I look out for. Right, you don't need to check every single thing to be for a good trade. Okay, what I'm talking about, right, is that usually when it comes to trading, you must imagine that you have a zero. If you take a random trade, you have a low chance of being profitable, right? Let's just say you add in a stochastic, right? Stochastic, right? So that check recent 3 bounces, do it line up nicely, blah blah. We have a pretty interesting way to use stochastic, which I'll be sharing with you later. Yvonne, I remember you from yesterday's webinar. Thanks for tuning back in again, right? So yeah, this is the, if we have a stochastic, maybe, we have about a 15% chance of being correct, right? You just apply a very simple stochastic oscillator, right? Then maybe when the stochastic is at a certain level, right, there's a trend line. So this might give us another 15% of being correct, right? It is aided by a death cross, no, golden cross or death cross. It might give us another 10% over here, right? There's strong correlation. If you're expecting a bounce on Aussie dollar, there is also a Kiwi dollar, right? And that maybe gives us another 10%, right? And then we have a reversal, Fibonacci, right? So we have another 15% over here, right? And you can see that along the way, by itself, each approach is not going to be profitable. But you have 15%, you plus 15, now you got 30%, you got 40%, you got 50%, you got 65%, right? And then maybe you throw in what's more, you can throw in natural moving average, you got another 10% over here, right? So you got a 70% chance of being correct. Right. And that is the approach where, what we call confluence, right? You don't just find one approach to trading. You find different approaches and they need to agree with each other. Now, a particular example I use over here is imagine if you go to a car workshop, right? You go to a car workshop, let's say you go to BMW, right? You go to BMW, right? And you ask them, hey guys, what's up, man? You guys got a car to recommend, right? And the guys there, right, what car are they going to recommend? They're going to recommend a BMW, right? And that's how it's you can ask as many of the salespeople in BMW, they're all going to recommend you a BMW, right? But does that mean that the BMW is the best car to own? Not necessarily true, right? We could go to another workshop, we could go to an Audi workshop, and you can ask the people there, and the people are going to say, yeah, BMW sucks, right? But Audi is great. There's all the reasons you should get an Audi, right? Now, of course, can go to, we can go to Mercedes, right? And all of them would recommend their own cars. And that is the danger when you are using, when you're applying technical analysis, right? And you're focusing too much on a certain approach. So for example, if you go to, what this means for example, is that you could be using, right? You could be using the RSI, right? You could be using the RSI, you could be using the stochastic, you could be using the MACD, right? Yeah, the MACD, you could be using all the different kind of oscillator indicators, right? They're all going to tell you the same thing, but that does not mean that it's correct, because you are using, right? You're using one study, right? You're using one study over there, right? Then maybe over here, everyone's talking about a moving average. You have the Ichimoku Kinko, right? You got channels, right? You got different kind of moving averages. You got things that just talk about momentum, right? So even though you throw on 5 different indicators and they're all telling you that it's bullish, you're actually, right, it's actually equivalent to you just going to a car workshop and say, hey guys, what's the best car? Right? All of them are telling the same thing because they're all studying the same kind of approach to trading, right? If you're looking at a moving average, a trend line, this thing is above a moving average, it's above a trend line, it's in the channel, right? It's above the Ichimoku cloud, right? Sure, it looks very bullish, but it's actually just different people in the different salespeople in the car works in the car showroom telling you the same thing. Yeah, BMW is great, BMW is great, BMW is great, but is it really great? Not really, right? So the key approach is actually combine them together. If they all say another, a particular car is better. For example, we have Tesla over here, right? If the people from Mercedes are saying that Tesla is great, the people from BMW are saying that Tesla are great, people from Audi is saying Tesla are great, then you know that Tesla is actually a pretty good car, because all these different people, right? They're saying, yeah, for electric cars, yeah, those guys are not bad, right? So you have different people giving, contributing to a common idea, right? And that's what you want to do for trading. When you look at the trade, they're looking for people to agree, the people in the Mercedes to agree, they're looking for the BMW camp to agree, looking for the Audi camp to agree, the Mini Cooper camp. They're looking for different people to all agree that, yeah, that is a good trade, right? That's why when it comes to trading, don't get too sucked in, right? Don't get too sucked into a particular trading style, right? Don't just look at a moving average and look at momentum and just forever play momentum, right? You need to look at momentum. You need to look at Fibonacci. You need to look at trend lines. You need to look at channels. You need to look at horizontal levels. You need to look at oscillators. You need to look at correlation, right? And this little checklist I created here is more or less the approach that I have to different little checklists. They are different from each other. Like stochastic RSI is different from horizontal levels, which is different from trend lines, different from chart patterns, different from moving averages. Then we have this thing called natural moving average, which we'll be covering in our future webinars. It's a very, very different approach to using moving averages. Then we got Fibonacci confluence. You combine different things together to give yourself the highest chance of being profitable. Okay, so I want to just highlight that this, set the foundation that this is the kind of the approach that we take to trading. Okay, it is the about finding confluence. Now let me erase this. I'm just going to how do I erase everything? Clear all drawings. Okay. What I want to encourage you guys to do is that if you have questions along the way, please send them right through. Okay, please send them right through, because more often than not, we might not have time for questions, right? I think I remember yesterday's session, we didn't have time to answer all the questions, right? So if you have a question, just send it in the chat room, in the chat section. I'll do my best to get to them. All right. Now, next thing we're going to talk about here. Let's go. Fibonacci. Okay. Some of you guys are going to ask, what in the world is Fibonacci? What in the world is Fibonacci? And I'm going to share with you how I actually use Fibonacci in trading. Okay, how I use Fibonacci in trading. Right. There are 4 main things that you use in Fibonacci. Okay. The first one, of course, right, we have the Fibonacci projections. Right, starting, middle, ending point. You probably won't know what this is, but you're going to see me use it a lot. All right, and we're going to cover it in our future webinars. So it's going to be pretty exciting stuff. But you at least need to know that when I talk about Fibonacci projections, this is what I'm doing about. There's 1, 2, 3 points. Right, we have Fibonacci retracements. Most people understand what Fibonacci retracements are. If a starting point, ending point, and you kind of just retrace all the way up. Then we have Fibonacci extensions, right? These are like, I always call this like a Nike tick kind of a setup, right? You'll be seeing me use a lot of it. If you can do some research into it, onto how you can use this. So you can watch in this example, I'm showing you watch the 127, 161.8, because price tends to react off these levels very nicely. And if you combine them together, it can be very strong. Then we got the Fibonacci expansions. I call this the Harry Potter kind of a move, right? So you can see it's a nice little Harry Potter kind of movement, right? And you're usually looking out for the negative 27, negative 61.8. So you look at over here, you're looking at the negative 27. And I'm going to show you how it works. Price tends to move to this level, right? Watch for a reaction of this level, right? Price tends to move to it, and price tends to reverse from it very nicely, right? Now, what do I mean by confluence, right? Confluence is when everything lines up together. Okay, first we got this. We got a Fibonacci projection, right? Second, so you can see down, the first, second, third point, right? Then we have a Fibonacci expansion. We combine a second form of study, right? You got 2 points there. Then we got Fibonacci extension. You can see the 1 to 7 over there. So we got 100, we got 1 to 7, and you got negative 27, right? So we highlight this as an entire area where price, there's a high probability of price bouncing from. So you can see price go down, test that area, right? And then from there, kind of takes off in the other direction. So that is the approach that we're going to take to trading. Okay, it's all about finding confluence, right? That means you're finding different studies that agree with each other before it moves, right? And now, right now that I've covered this last part with you, let's go into looking at the markets together. Okay, let's go into let's go and look at the markets together. Right, here we go. Here we go. Let me find where's my charts? Where are my charts actually? Okay, now I'm going to load up my trading view account over here. There we go. That's a picture of my cat, by the way. All right, so okay, see, Darlington just said that I can't see out my chart. Can you guys see my screen? Are you guys able to see my screen? Yes, okay, awesome stuff. Okay, that's great. Thanks for letting me know, guys. Okay, now is the time, right? If you have requests for any currency pairs or any instruments, let me know, right? I'm going to dive into my my analysis mode over here, right? So if you have a request, now's the time to look at it. Okay, we already got NASDAQ coming in. I'll look at NASDAQ in a bit. Okay. But yeah, let's begin today's live market analysis session. So I'm going to show you, I'm just going to look at NASDAQ right away. Okay. Right. Let's go look at NASDAQ right away. Let's pull up the CFD because most of the time we have CFDs, right? Yeah, NASDAQ 100. Okay, this is not CFD. Let me, yep. Let's use this. Is this okay? Okay, we use this CFD. All right. Now let me show you the common approach I take to analyzing something. Okay, got a goal from Natalia. That's great. So most of the time, some people are just too zoomed in, right? So this is, for example, the 1 hour chart. Sometimes you're a little bit too zoomed in, but what you should do is you should take a top-down approach. Right, a top-down approach means that you need to respect the higher time frame. Okay, let me show you how I do that. I usually look at the 1 day chart. Right, 1 day, at most the 1 week chart, to give yourself a gauge, right? Look at the 1 week chart here, you're like, well, I can see there's something happening here. I can see there's a big low here and all the way up there. Let me see if I can get a chart with a little bit more history. Yep, there you go. So you notice how I can sometimes change the chart to get a little bit more history, right? So in this case, I now have a lot more history I can look at all the way to 2015. Right. So the first thing I'm just going to highlight here is I look at the chart. I'm like, all right, there's a nice little Fibonacci over here, starting point over here, ending point here. Price, even before I do anything, I already noticed that price is testing this 50% retracement. Okay. That is my guiding principle, my guiding idea on the higher time frame is that, okay, price is testing the 50% retracement. Good to know. Good to know. Right. I then throw on a couple more levels. I do a zigzag kind of Fibonacci projection over here. Price is just about testing the 100%. So zigzag, meaning that I'm looking at this little zigzag movement, right? If there's a secret to trading the markets that I'd like to share with you guys, a lot of it is Fibonacci. It's not easy to use. A lot of people use it wrongly, but if you know how to use it correctly, man, you can trade the markets so accurately. Okay, but all right, so I just highlighted that there's a 100% Fibonacci projection over here. Okay, then I'm going to look at a Fibonacci expansion. We could be seeing something. All right, there is a negative 27 level there. So I'm just going to filter out negative 27 Fibonacci projection, Fibonacci expansion. Last one is this, what I call reverse Nike take Fibonacci extension, right? I know it sounds a little bit confusing, but I can see a 161.8 right about there. So I'm going to filter this out. And I'm a big fan of making things very neat, right? So once I filter everything out, right, I can start to see that at this level over here, right, at this level over here, I know that it looks like Nasdaq is in free fall, but at this level here, we got a 161 extension, we got 100% projection, we got negative 27 expansion, and we got 50% retracement. Man, we have quite a number of levels over there, right? And this is actually quite a strong support level in this case. So I'm just going to remove all the different brushes that I just drew, right? So it's slightly neater, but that means we could be seeing a nice bit of support over here. I'm going to highlight this as a support level right away. So this forms our first slightly larger bias that, okay, right, we are seeing support. Now we go into the daily time frame, right? We go into the daily time frame and then we just zoom in a little bit more. Is there anything else, anything different that the market is telling us over here, right? Is there anything different that the market is telling us? Give me a second while I look at it. Honestly, not really, but I do see that there is a nice little bit of resistance over here. This is a nice bit of resistance, right? I'll put it as my first resistance, right? Why is it a nice bit of resistance? It's because price has bounced one time, price has bounced 2 times, price has bounced 3 times, and it finally broke this level. Actually, it also bounced a 4th time over here, right? So in terms of levels that are playing to, this is definitely one of the key resistance levels that we're looking at. Okay, one of the key resistance levels that we're looking at. So I should just highlight it first, and I just highlight it and know that that's a resistance level. When it comes to trading, right? When it comes to trading, the approach is to play from one resistance to one support to one resistance. That allows you to maintain what I call your locus of control. Okay, let me just really quickly explain to you here in case I might be confusing you guys. If I thought that this, let me just take out my handy dandy pen. If I thought this was a support level over here, right? And I think that there's a high chance that price might bounce from here. Okay, price might bounce from here. I can play it to a few levels. Okay, let me just draw it out for you. Right, we got 1, we got 2. We could play it to 3. We got played to 4 over here. Okay, now I'm just going to call this point A, point B, point C, and point D. Now, which has the lowest chance of price reaching it? Right, A, B, C, or D? Right, which target level has the lowest chance of price reaching it if price is really going to bounce up from here? Anyone want to take a guess? Right, we got Tahiwo guessing that A has the lowest chance of price reaching it. Right, Mokonoto is also saying A. Anyone? Okay, this is part of the learning process, right? So you guys can actually start guessing, right? What do you guys think? What has the lowest chance? Which level has the lowest chance of price reaching it? Okay, I mean, this Zakir Fawas actually just said D, right? if I was just saying D, right? We got Mashboop saying D, right? Darlington saying D. All right, got a couple of you guys saying D also, right? So why is it D? Right, okay, Kana saying D, why is it D? It's because D is the furthest. D is the furthest, okay? And because it's the furthest, you naturally have the lowest chance of price reaching it, right? You naturally have the lowest chance of price reaching it. Just think about it like a weather forecast, right? If there's a weather forecast that tells you that, okay, it's going to rain in 1 hour, you look at the sky and like, yeah, it looks like it's going to rain in 1 hour. You have a high degree of confidence that it's going to rain in 1 hour, right? But if you have a weather forecast that tells you that it's going to rain in 1 day, right? You'll be like, okay, fairly reliable, but I don't. It might rain. There's a chance that it's going to rain. But then you look at a weather forecast that tells you it's going to rain 1 month later, right? 1 month later, it's going to rain. Are you going to trust that? How much confidence are you going to put in that weather forecast, right? It's as good as not having a forecast, because what's going to happen 1 month later? How do we know it's going to rain 1 month later? So much can change. It's so far away, and because it's so far away, it's very hard to estimate, the reliability of that forecast. And that's how it works with trading too. Okay, the further away your forecast is, right? The further away your forecast is, the lower there is a chance of it being accurate. So much can happen when price is from here going all the way up to here. So much can happen, right? And therein lies a problem, because so much can happen, right? There's you could be right all the way to maybe B, but suddenly Russia, Ukraine could do something, right? And then you go completely in the other direction. What you want to do in trading is that, like in any game or any endeavor, you want to maintain your locus of control. You want to stay in control, right? And to stay in control, you need to, in our example over here, you need to be able to ideally trade to the next closest level. Okay, you want to trade to the next closest level. The closer it is, the more in control you're going to be. So A would be correct in the sense, A would be the probability, the highest probability of price going there. And D, because it's the furthest away, is like our weather forecast 1 month from now, right? You have the lowest chance of price actually being correct, in that example. Okay, so important things for you guys to take note of, right? Important thing for you guys to take note of. So I'm going to erase some of the drawings over here so that it's slightly clearer for us, right? Bam, just going to erase some drawings, right? Okay, so in our example, right, I know we have A, B, C, and D over here, but we're not going to play to A, right? Because A is a little bit too close, right? We're just going to play to B. We're not going to play to C and D because it's too far away. What I'd like to do is to play to the next strongest resistance level. For example, you compare this resistance over here, right, where you got 1 bounce, you got 2 bounce, you got 3 bounce, you got 4 bounce, and you compare it to this little tiny swing high over here, right? Obviously, right, this point over here, right, this one over here is much stronger than the point below, right? It's much stronger, right? And that's why you play to that. You don't play to those stuff in between that's just really, really weak, right? And when we touch on the support and resistance in the future webinars, right, I'll be able to show you guys, how you can filter out good support and resistance levels. Okay. Now let's go into here, right? So we're going to play to the first resistance, and this is the support, right? Why is it a good support? I shared with you earlier. 50% retracement, your starting point here, all the way to your ending point. Price retraced 50% over here, right? That's why it's right about there. Okay, that's one of the reasons why this level is strong. The next reason is strong is because of this 100% projection, right? Starting point, middle point, ending point, projecting downwards. And so this movement from here down to here is the same as this movement, 100% projection down to here. Okay, so that is another reason why 100% projection. You got a 161.8 Fibonacci projection that comes down here, and got a negative 27 Fibonacci extension that comes down to here, expansion that comes down to here. So a lot of support over here that we expect it to bounce. Okay, that's the first thing we are going to establish, right? Palessa, nice to hear from you. Yeah, we're right at the support level already. So my bias, right? My bias is that we are likely to see a bounce, right? We are likely to see a bounce, and for price to come from here to bounce up to here. Yeah, this is my bias, right? The bounce might have happened over here, but I'm more confident. Let me see. The bounce might have happened. Because what I like to play to is usually at 23%. I can see that price actually did a small little bounce from here and actually touched the 23% over here. But looking at the daily on the larger time frame, I actually think that there's a good probability that price will retrace to this 38. So we could be seeing a nice little bounce over here. Okay. Now let's just say, right? Let's just say we have this as our, I call it the pivot, but some people use it as the where's the world is my pivot. Yeah, this is a pivot level where price might bounce from, but where would you then place your stop loss, right? Usually, right, in this example, stop loss and take profit placement. So one of the things that I'm going to teach you, or rather, one of the great things is that I know I haven't shared this with you guys, right? But actually, you can go to ironfx.com. Right, there is a page that you want to go to, right? The page is let me find it. It's taking a while to load. IronFX School, right? You want to click on this thing called podcast. Okay, I'm the one who currently contributes some of the podcasts over here. But yeah, oh wow, that's fast, right? Should you use a fixed stop loss, right? That is, I just did a little bit of podcast sharing with you guys on whether you should use a fixed stop loss or not. Please tune in here and check it out, right? It's a nice little short 5 minute or 6, was it? Yeah, about 5 minute podcast for everyone to look at, right? Really, really nice bite-sized educational topics for you to look at. All right, so please go check it out. Okay, yeah, it's great because IronFX, giving you webinars, we're giving you podcasts to tune in and listen to, right? I mean, we're just really doing our best to really make you a better trader. Okay. Right, mucha, right? Thank you for tuning in, right? I'm glad to see you here, right? And I hope to see you in our future sessions. But now, pivot, resistance. So this is more like our entry and take profit that we identified, right? We're going to play a bounce from here to here. Where is our stop loss going to be, right? Where is our stop loss going to be? So what we tend to use for our stop loss is we need to find the next key level, right? In trading, most of the time, people tend to be too absorbed into just finding the entry. Right? People are just so absorbed, like, okay, let me find my entry. Once they find the entry, they're like, okay, bam, 50 pip stop loss, 50 pip take profit. That's it, right? But that is a bad approach, right? That is a bad approach because, when it comes to trading, right? Most people think you have your entry, you have your stop loss, and you have your take profit. Okay, most people think it's this. Most people only focus on entry. But let me tell you that your stop loss placement and your take profit placement are equally important, right? If you spend a large amount of time to find your entry, you must find an equal amount of time to find your stop loss and your take profit. They are all super duper important. And we will touch on in our future sessions, in our educational sessions, we'll be touching on things like the entire anatomy of a trade, right? Meaning that we have break even, right? We got break even, we got partial profit, we got idea invalidation, we got trailing stop loss, right? There are so many different things that goes into a trade, right? It's not just your entry. At what level do you move to break even? At what level do you take up part of your profit? At what level do you invalidate your idea? Try to cut your losses. At what level do you trail your stop loss? At what level do you cancel your trade, right? There are many ways that goes into the anatomy of a trade. And if you really want to take a trading to the next level, you need to embrace that, right? Future webinars, we're going to cover all these advanced, beginner, intermediate, advanced kind of trade management approaches, right? But yeah, I just want to let you guys know that when it comes to trading, don't just look at the entry. You have seen me find the entry, but you see me put an equal amount of effort to fine tuning and knowing where to put my stop loss and where to put my take profit. Okay, now just let me erase some of my drawings, right? Oh, wow, I use the brush a lot, man. I use the brush a lot. Okay, now we have an entry, stop loss, take profit. Okay, where we're gonna put a stop loss. So how I usually do my stop loss is I try to find the next key level. Okay, so let me see over here. We got -27. What if I look at the -61.8? I see a level down here. Okay. Does this line up with a 61.8? It does. Okay. We can find this as the next key level, right? So we could actually use this as our stop loss, right? So this is going to have a support over here, right? So technically this would be more like a 1:1 kind of setup, right? Your entry, your stop loss, your take profit, kind of playing the bounce from there, right? It's a little bit far away. It's a little bit far away. So there are two approaches to this. There's a risky approach and there's the not so risky approach. So it depends on your risk tolerance level. Okay. But when it comes to trading, you must ask yourself, why am I putting my stop loss there? Why am I putting my stop loss there? Is there a reason that I'm putting it so far? Is there a reason why I put it over here? Do I expect prices to come all the way down to here before bouncing up? Right? Is there a reason why I'm putting it so far? Right? So usually when I get into trade, this is my conservative approach. This is where I'm letting it breathe a little bit more, have a little bit more breathing space. But most of the time, the approach that I use to trading is that my stop loss placement, I will put it just slightly beyond, right? Just slightly beyond this area over here, right? Now, let me explain the concept to you, right? Let me explain the concept to you and how it actually links to the whole big risk to reward and profitability of a trading strategy, okay? I am expecting prices to bounce from here upwards to here, okay? You must think about the thought process as I'm teaching this, right? I'm expecting it to bounce up. Okay, I'm expecting it to bounce up. If it doesn't bounce up from here and it breaks this level, okay, if it breaks this level, I am wrong. Okay, I am wrong. And I should take it on my chin, meaning I should take the loss right away, right? I don't need to have my stop loss all the way maybe down here, right? So imagine we're in a trade, right? Imagine we're in a trade and instead of price bouncing up over here, and guys, you can apply this to all your trading strategies, right? The thought process that goes behind this. Right? Imagine we're expecting prices to bounce up over here, right? And prices don't bounce up. They actually drop lower to here. Now, okay, it has dropped to this level. And at every point of time, you need to ask yourself, why am I still in this trade? If prices came all the way down to here, we expected it to bounce up. It did not bounce up, and it went all the way down to here. It's at here, this level. We're not here now. What are we expecting it to happen? Are we expecting prices to go all the way down here and suddenly bounce up to our take profit? Or is that a completely different study? Is that a completely different strategy? Right? Is that a completely different strategy? Are we unnecessarily paying for comfort? Now, what does that mean? Everyone knows the comfort that a wider stop loss brings you. You put stop loss away. Wow, the market can come all the way to here, and you're like, yeah, my stop loss is far away. I don't need to worry about it. But you are paying a price for comfort. You're paying a price to have a further stop loss. You're paying a price for that, for that good feeling you have that you have a further, your stop loss is far away. What do I mean by that? Okay. Now, in this example, right, let me just show you what I mean. We have this little thing here, right? So this is a long position. Our entry is over here. Our take profit is over here. And our stop loss, right? Okay. Let's just say our stop loss is over here, right? Our stop loss is right about over here. Now, what is your risk reward? I wonder, can I zoom in? Can I zoom in and can you guys see? Text, why have I more text 24? All right. Oh, wow, huge. Okay. Text 20. Okay. I never knew I could do that. All right. So what is the trade, right? You see your take profit, this is your stop loss. What's your risk to reward? your risk to reward is 1:1. Okay, your risk to reward is 1:1. So if you trade 1%, and you hit the take profit, you make 1%. Okay, now let me repeat that again. If you allocate 1% to this trade, right, and you hit, it is correct, and price really bounces up, and price really helps you make that money, hits your take profit, you make exactly 1%. Okay, if, however, you have a tighter stop loss, look, I want you to focus on this number over here, risk to reward. Okay, if you tighten your stop loss, right, tighten your stop loss, it increases exponentially actually. If you tighten your stop loss to over here, like what I initially wanted to do, right, let me put it all the way to here, right, 1:3. You can see over here. Now, if you got the trade correct, right, your risk to reward is 1:3, meaning that if you risk 1% on a trade, you will have made 3% with the trade hitting your profit target. And if you get one of these trades correct, for next 3 trades, if you lose money, you still break even, right? So that is what I mean, right? But if this requires you to tighten your stop loss all the way to here instead, right? Tighten your stop loss all the way to there. It might be a little bit more uncomfortable. You might feel a little bit, because it's a tighter stop loss, you feel a little bit more anxious, right? But remember, everything comes at a price, right? If you can train yourself, right, to be able to embrace that style of trading, you go into very, very good risk to reward trades. You get one good trade, that's enough to cover up for 3 trades that didn't go your way. Okay, right? But if you feel, if you don't want that much comfort, you want a lot of breathing space. So a lot of people just put their stop loss very far away. They put your stop loss so far away, what's going to happen, right? Your risk to reward is 0.5. You get one good trade, you risk 1%, you only make 0.5%. You need 2 of such trades before you even make a little bit of money. So that this much breathing space, right? This much breathing space from here all the way to here is costing you money. If you think about it, it's actually costing you money. There's a price you pay for comfort. There's a price you pay for feeling safe, right? And is it worth paying that price? That is where you need to look at your trading strategy. Is there a reason, right? Always ask yourself, is there a reason why you're putting your stop loss at a certain distance, right? Is there a reason why it's so far away, right? Can it be tighter, right? Are you paying unnecessary risk to reward, your profits just because, you want a further stop loss, right? So these are important questions that you need to ask yourself when you trade. So in my situation over here, sure, right, we can put it here to be safe. This is the 1:1 risk to reward setup that we can do. But personally, my idea is that price should not be breaking this level over here. I have so much support over here that price should actually be bouncing up. If I'm wrong, I want to be wrong right away. I don't want to live in the land of what I call hopefulness, right? Live in a land where price might bounce up. Imagine if price comes all the way down to here. My original analysis of price bouncing up does not apply when it's over here. It does not apply when it's over here. It does not apply when it's over here, right? So my original analysis, if I'm right, I want it to be right, right away. If I'm wrong, I want to take it on the chin right away. Imagine you're courting a girl, right? Yeah, courting a girl, right? No one likes mind games, right? If she likes, you tell her, if you like me, you just tell me that you like me, right? Don't play mind games with me. Don't tell me like, okay, I will give you an answer, right? Imagine if you propose to someone, right? You propose to someone, will you marry me, right? Will you marry me, right? And the person says, let me think about it. I'll get back to you in maybe 1 month, right? You'll be thinking, wow, that's terrible, right? That's terrible. What am I going to do for the 1 month, right? There's so much indecision, right? And you should take that kind of approach, that decisiveness when you come to trading. You just want to know whether you're going to get it right or you're going to get it wrong, right? Don't try to buy yourself that kind of uncertainty. It's like, yeah, 1 month, yeah, sure, that's fine. Think about it for 1 month, think about it for 1 year, right? And it's going to be terrible, right? You're not going to feel good, right? And that's the approach you should take to trading. If you have a strategy. You either want to be right away, or you want to be wrong right away. You don't want the market to toy with your feelings. Okay, and that's how you do that, is to know why you put your stop loss at a certain level. I put it here. If I put it so tight, it's because I know that the market did not respect my original analysis. I might have a 70% chance of being correct, but the 30% chance that I'm wrong, if I'm wrong, just take me out right away. Right? I know that if I'm right, I'm going to make a good 1:3, 3 times profit on the trade. But if I'm wrong, I take a one-time loss. Okay, this is the view on Nasdaq. I'm going to take one last moment to take a look at gold, because someone requested gold. I think we actually made a forecast on gold a while back, right? It actually hit its take profit. I can actually show you guys how we did this analysis on gold. I wonder if I might have it somewhere. I know we have a recording on how we got this analysis on gold, and we have it over here. Let's see if I have it. Yeah. So this was my analysis on gold. I'm going to show you that, you know, you can actually forecast the market with such accuracy, right? So yeah, so this was my analysis on gold. I posted on May the 20th, right? How do I hide this little thing over here? Okay, so you can see, right, that this was the analysis that we had on gold. Okay, price broke out of this trend line, right? Broke out of this channel, rather. You can see it broke out over here, right? It broke out of this overlap support, right? You can see there's a nice little double bottom pattern over here too, right? You can see over there, right? There's nice overlap. Price broke out from there, right? And at the same time, it has broken this key 23% retracement. Very big, a very interesting, very important thing that I need to teach you guys, right? In terms of Fibonacci numbers, if price breaks the 23% retracement, it borrows its theory technically from Elliott wave, but it actually is the first signs that, you know, price is going to make a good recovery. Okay, so it breaks the 23% retracement, right? And we're going to play to this next overlap, right? We don't play to the 38%, we just play to this overlap. I'm going to show you over here. That's the take profit, right? And, you know, we're going to put a very, very tight stop loss. Notice my stop loss is very tight, because I believe that if price really forms this double bottom, price really breaks out of this channel, price really breaks out of this overlap, there is no reason why it should drop back down. But if it does drop back down, you know what, just take me out right away, right? I want to be wrong. If I'm wrong, just let me know I'm wrong. But if I'm right, I want to play, and this is a nice 1:3 setup that we have over here. Okay, so you can see from there, that was a move we called for price to bounce all the way up to our take profit over there. Bullish arrow, there we go. And of course, this was the original analysis that we did. We can see that price really did bounce off here and go all the way up. You notice that it barely even went a little bit against our stop loss. We literally had 0% drawdown for this trade. And importantly is that it hits our take profit and then reverses, right? We could have played to the 38% actually, right? But yeah, so this is a pretty good setup. Now, the questions that you guys have is, what do we expect for gold? Let me do a quick analysis on the 4-hour chart for it, right? Let's see. Oh, what am I drawing? I do notice that there could be a bit of this is a channel, okay? This is a channel, and this is a bearish channel breakout, okay? Bearish channel, okay? What do I mean by that, right? You can see that, you know, price must minimally do 1 touch, 2 touch, 3 touch, 4 touch, minimally 4 touch, but this has 5, about 6 or 7 touches, okay? So this is a valid channel we have over here. And what we're looking at is that price has broke the channel. Means that there is a natural inclination for price to drop down, right? For price to drop from here. Okay. Now let's see. That is my first bias that I'm looking at. Okay, Ichimoku cloud, right? It's still above, a little bit of support over here. In terms of graphical support, I notice there's a nice bit of graphical support over here that we're looking at. So we should be ideally seeing prices at least drop all the way down to this level. Okay, let me see. Let me see. Is there any key level I'm looking at? Right? No. Yep. Overall trend, you know, price is kind of still inching lower, right? But this nice little channel breakout could be what we're looking at. Now, let me see if I'm missing any other levels. Nope, no other levels I'm missing, right? which is the 50% retracement. So yep, we are playing down to the 50% retracement over here. Okay. So if you're asking me about like the potential entry area and stuff, right? This would probably be our pivot, right? This will probably be my pivot over here, right? We are playing down, we're playing a nice little move. It might be easier on the 1 hour chart, right? As you can see, we're playing a nice little move down here. On the 1 hour chart, we can see that price, right? Which was originally holding very nicely above the Ichimoku, broke, come out, dropping down, okay? So that is where we're expecting prices to kind of drop down to, right? This overlap support 1830, at least for the next couple of hours. Okay, that's one of our key moves. In terms of potential stop loss placement, you can just put it above here. If you want to play it very safe, right? There's no reason, right? So in our idea, right, why the stop loss placement is there is that there's no reason price should reintegrate back into here and reintegrate back into the channel, right? This price reaction, bounce, right? So this is a key resistance level. The pivot is a key resistance level. If price really broke it, we expect it to drop down to there, right? There's no reason for price to come back up to here. That's why we can put a slightly tighter stop loss, right? And this will give us probably a risk to reward. Nice little short position over here. A nice little risk to reward of maybe 1:1 is to 1.67, almost 1:, is a decent setup, right? Decent setup that we're looking at for gold. Okay. Yeah. So anyway, guys, right? You will notice there's a lot of stuff that you need to practice, right? There's a lot of stuff that you need to practice. And there's one thing that I want to show you guys, which is the VIP room. Okay. I'm just going to take a moment to share the VIP room with you guys. Let me see if I can have it here. Yep. I need to change my screen sharing. A desktop one. Okay, so this is a glimpse of the VIP room, which we'll be releasing to you guys probably next week. Okay, as long as you are an IronFX client, you get access to this VIP room. And what I want to tell you guys is that this is the place where you get direct access to me. You get direct access to a whole bunch of really, really talented analysts, prop traders that I have. And it's a place where you're going to practice your analysis. You're going to practice your trading. Okay, how it looks like it is that, if we're looking on, if you're looking at maybe euro dollar, let's do euro dollar. Should we do euro dollar? Or maybe we could do euro dollar, right? So you can see there's a chart over here, and there's a chat section over here. Okay, so let's just say we're looking at euro dollar, and you're thinking, okay, I'm going to erase all my drawings over here. I'm just looking at it here. I'm thinking, Desmond, is this a trend line? Right, so you can say, hey, right, hey Desmond, is this a trend line? Right, so you're not sure if it's a trend line. You can actually highlight your text over here, right? You can click this button called link object to text. Okay, you can just select any object that you just drew. In this case, we can draw this, right? We can, we can draw this support level over here. Whatever we draw will appear over here. Okay, click confirm. And we send the message through. And what happens, right? Of course, we can see there's a little bit of experience points and there's a little bit of gamification, right? So the more you participate, the higher your rank gets, right? So it's very fun, a little bit of gamification there, right? But you can see, hey, Desmond, is this the trend line? So I'm looking at it. I'm like, what trend line are you referring to? When I hover my mouse over it, I can see that this, it lights up on the chart directly. You can see that, right? I hover my mouse over it, it lights up. And that allows us to go into a little dedicated discussion on this trend line area. Okay. Hey, Desmond, is this a trend line? And I can reply to you, yeah, it is, right? And then maybe we can continue a discussion. I can say it bounced off the 23% retracement. We can expect it to go a little bit higher. But what happens is in here, two things are going to happen. One is my team is going to be posting our analysis. We're going to highlight the key levels for you to look at. For example, with gold, we can highlight, a channel, right? You can highlight this is a potential trade to look at. And you can also, the second thing that can happen is that you can come in and you can use it as a place for you to ask questions, right? Practice, practice, practice. Honestly, that's all you need to do, right? But practice with the correct teacher. Don't practice with random people, right? You're practicing with institutional grade traders, right? People who trade for a living. And that is where, we can really guide you to be a better trader. All you need, of course, is an IronFX account. We will give you the link to this special VIP room next week. Okay, and it's definitely something to look out for. It's pretty exciting. It's pretty fun, right? So I hope you guys, you have. Kelvin is asking, do you have a signal group, right? We don't have a signal group, but in the VIP room, we don't really call it a signal. We call it more of a VIP, a place where we share analysis, share education. We highlight the levels. We highlight the places where it might reverse from, where it bounce from, right? That is what's going to happen in the VIP room. Right. Yeah, I'm glad you find it interesting, Yvonne and Natalia. Right. I'm glad you found the explanation goal useful. Right. Hopefully the trade works out. These webinars are all recorded. So, all you need to do is go into the IronFX YouTube channel and you'll be able to see all the recordings over there. Right. So whatever trades I make, the NASDAQ setups, the gold setup, right, you will know next week whether I'm going to get it correct or not. Right. So what I'm going to encourage you guys to do, I realized I've stopped sharing my screen. Right. One page that you need to go to is coming to here, and where is it? You want to click on this thing, webinars, right? I'm going to send you to the link, right? The link is actually down here, right? Not in 13 days, rather. Technical Analysis 101. Okay, this is the link which you want to go to, right? It's the IronFX webinar series. I'm going to send it for you guys. I'm going to send it rather for you guys to take a look at, right? I'm going to send it for you guys to take a look at. Please register for that. It's our IronFX webinar. And of course, you can go look at IronFX YouTube channel, if you can find it, right? IronFX YouTube. I'm not sure if the latest webinar recordings are there because I saw that a couple of people, okay, I see some questions asking like how much it costs to join. It is free to join the IronFX webinar, no, IronFX VIP room, right? All you need is an IronFX account, right? I think the minimum account size, we are still finalizing it, but yeah, all you need is an IronFX account and you would have access to this VIP room, okay? Now, that's it for me, guys. Thank you so much for tuning in. I will catch you guys next week. Remember, until then, stay safe, trade safe, and peace out, guys. Stay safe, trade safe, and peace out. Take care, guys. Adios.
Shares represent equity ownership in a company or financial asset. Trading in shares provide access to the stock market of some of the largest and most popular companies, such as Google, Amazon, and Apple. You can invest in shares online with CFDs and gain full exposure with a small initial deposit. CFDs allow you to speculate on price movements without physically owning an underlying asset, and you can trade both rising and falling markets. With the growing popularity of CFDs, an increasing number of traders prefer trading shares through CFDs instead of via traditional shares. This is due to advantages offered by CFDs, such as leverage and the ability to go long and or short. In addition, fractional trading makes it easier to diversify your portfolio while investing in multiple companies for a fraction of the share. With share CFDs, you can boost your buying power by trading with leverage. CFDs are leverage products, which means you can control a large contract value with a small deposit. Known as margin, essentially you only need to deposit a small portion of the total trade value to gain full exposure to the markets. CFDs provide potential to profit in both rising and falling markets. Basically, traders who trade CFDs are speculating on price movement by taking short or long positions to profit on the asset's price going down or up, respectively. You don't actually buy or take physical possession of the shares, and you can still make a profit when the price of the share falls in value, not just when it rises. Share CFDs allow you to invest in shares from several markets around the world as well as in other instruments. This is known as diversification.